In analyzing the potential results for the midterm elections, what happens to investors' money? Let's say the S&P 500. What happens 6 months down the road?
Well, 6 months down the road, the results are very positive. Going back to World War II, the average gain has been 15.3%. And I also like to look at batting averages. I'm like Pavlov's dog. I want to get fed frequently. And up 16 of 17 times. So a very strong batting average at 94%.
And the 15.3% increase, this 15% increase in the S&P 500 6 months out, it doesn't matter who takes the House, who takes the Senate, who wins anything. It's just about the election.
Exactly. It usually starts on a low note, if you will, uncertainty heading into the midterm elections. And then as we start to enter year 3, that's the year typically that the president will want to introduce legislation that might stimulate the economy, make voters happy to reelect him or his party in year 4.
All right, we want to look a little further over the horizon. That was 6 months. What happens 12 months out?
12 months, the average gain is only about 200 basis points higher at 17.5%. But the interesting thing is it's been up 17 of 17 times. And one of those observations included the great crash of 1987. So you were still able to eke out a 4% gain, even with that kind of a decline.
Now, I know you did some work where you kind of said, all right, what happens if you've got a unified Congress and you have a president from another party, which may be what we wake up to tomorrow. Give us some of the permutations that you put together.
Well, basically what I found is that if you have a totally unified government, president and both houses of Congress, same party, that's the best in general. Second best is when the president has to compromise with a unified Congress of the different party. And the worst on average is when you have a split Congress, because Congress ends up impeding rather than leading. Within that, I found that the best average performance since World War II was a Democratic president with a unified Republican Congress. So maybe we'll actually get some legislation work its way through Congress because the president realizes, let me introduce something that will make both sides look good, and it gets pushed through.
All right, let's look at some specific sectors and how they performed. Sectors that beat the S&P 500, what, 50% or more?
Right. What I found is that just as you want to be defensive from May through October, you equally want to be cyclical from November through April. The best sectors have been consumer discretionary, industrials, materials, and information technology. And interestingly enough, if you had a 25% exposure to each one of those sectors, you would have beaten the market about 75% of the time during all years and 100% of the time following midterm elections.
So it's possible that if you just divide up the portfolio, 25%, a quarter in each of these sectors, you say this is better than doing anything else.
That's right. I mean, history is a wonderful guide. It's not a guarantee. But when you have a pretty high batting average, I think really what investors should take away from this is if they have an awful lot of cash on the sidelines, much more than their real allocation indicates, maybe this is an indication to get back to neutral and to not be too afraid, of the next big one coming around the corner.
Well, that's what I wanted to find out is, are people already investing with anticipation for this surge in stock prices?
Well, I think because we got back to break even in about a third of the time that it historically does, investors said, yes, that 7+% decline in the S&P 500 was a buying opportunity. And again, history says that we probably will be advancing about 8% after getting back to break even over the coming 3-month period before facing another decline possibly of 5% or more. So good times over the next several months.
Does it can we factor? Is there any way to factor in interest rates in this? Because it's not as if we've had a lot of midterm elections with interest rates this low.
Absolutely. I mean, everyone says, well, history is nice, but what about the fundamentals? Do they support that? And if you look to S&P Capital IQ earnings estimates, which are pointing right now to about $129 a share for the end of 2015, add to that the low inflation rate. Right now it's 1.7. Maybe we give it 2% by this time next year. That would imply we could easily be above 2,300 on the S&P 500. And the only headwind that I see really is a rising interest rate environment in the second half of next year. So maybe we don't end up with as stellar a performance as a gain of 17% on average as we saw since World War II. But maybe something in the high single digits.
Well, the S&P 500 is up more than 8.5% so far this year, so maybe they still got a little bit more to go.
Absolutely. Well, the November, December are typically the best two after midterm elections.